Hi, David Bassanese here, Chief Economist at BetaShares. This is a snapshot of my latest market trends report. And just reviewing the month of April, well, it was really a fairly sorry tale. Unfortunately, we had weaknesses in both bonds and equity markets on the back of a big rebound in bond yields. US 10-year bond yields are up almost 0.5%. Back to 4.68%. The US market pricing in was gone from expecting 3 rate cuts this year at the start of the month now to one. Possibly 2, but certainly pricing out most of the remaining rate cuts that it was expecting this year. Now, why is that? We did get another US CPI inflation result for March. It was the third month in a row where it was a bit higher than expected. Not only that, the US Federal Reserve, which was initially dismissive of the initial higher inflation results, did concede that inflation wasn't coming down as quickly as it was hoping, and it did signal that it's probably less likely to cut rates as aggressively as it was thinking at the start of the year. So really just confirmation that the Fed was noticing that the inflation was being a little bit sticky. The third other element through the month was an escalation of Middle East tensions, particularly the tit-for-tat exchanges between Iran and Israel, and there was obviously some concern that might escalate, which could see oil prices spike and make the inflation challenge globally even worse. So net result, bond yields up, rate cut expectations pushed back, and equities weakening. So the MSCI All Country World Index had a negative return of 2.8%. The Australian market was down 2.9%. Fixed rate bonds lost between 1 to 2% on the back of the high bond yields. Now, one area of the markets which did hold up was gold. So gold has been having a few months of pretty good performance, holding up in the face of this rebound in bond yields of late. So gold prices in US dollar terms up 2.5% after a 9.1% gain in March. And as a result, global gold miners, such as through our global gold miners ETF, MNRS, delivered a 6.3% return. So just an example there of where gold in certain environments can add good diversification to one's portfolio. Broadly speaking, within equity markets, as you would expect, it's been the growth technology areas that have been hardest hit by the backup of bond yields. Some of the more value exposures, financials, energy holding up a little bit better. Even emerging markets bouncing back. And in fact, one other little story emerging is maybe growing confidence that the worst is behind us in terms of China, and maybe the Chinese equity market is starting to pick itself up off the ground. That's pretty much it for now. More details on the full range of things going on in global markets available in my market trends report on the insight section of our website. So please go there if you'd like to get more details. Thanks for watching, and I'll see you again next month.